Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, good Friday morning, Dima.
Good morning, Will. How are you?
Good. This Demon's getting
Excellent.
ready. Why doesn't everyone like us? Follow us on YouTube. Give us thumbs up. It's always appreciated. It's last day of the week, buddy.
Yep. Happy holidays to you. Fun. Oh, we're here Monday, right? Monday is
I think Monday, and then I think it's off the next day. Let me take a look at exchange holidays real quick. I'll let you know.
okay. Good morning, everyone. While Will's looking at that, what we'll do today is look at a trade idea in SPY. So if you come to the SPY page, you just type it up here in the search, SPY, like this. You'll come to this page, and on the left-hand side, under options, trade ideas, click there. And we're going to get these trade cards. I'm going to close this menu to expand the screen. And we come to these top three trade cards. These are sorted by top three by edge that are auto-generated based on certain conditions that we set in our different option strategy screeners. So if it meets these conditions, it could generate these trade ideas for further review. If you're looking for a particular type of strategy, you could click on this strategy selector and just go to it and pick it out and see if anything pops in here. And these are just quick starting points. If you wanted to go to the option screener and put in your own criteria, you can do that. We're not going to do that today. We're just going to focus on these trade cards. So looking at these three, we produced one debit iron condor, a bear put spread, and another bear put spread. So if we come down here, we could see the legs of the spread, because we talk about an option strategy. You could just do a call or put, or if you do a combination, you have to define what combination you're doing. A bear put spread would be two options. You're buying one, selling another in the same expiration. Okay, so this bear put spread is in December 27th. We're analyzing buying the 589 put, selling the 585 put. This one is in January 17th. This is analyzing buying the 592 put, selling the 587 put. So you can see they're different. One expires earlier, December 27th. One is a longer dated, January 17th. And you have different strikes here. So these strikes, 589, 585 versus 592, 587. So this one is a little bit more in the money. So let's review this middle one. Okay, this put spread, it was generated because it had at least a 10% edge from this is telling us why it was generated from our screener. It had at least a 10% edge, and out of those, this one had the highest win rate in the screener. Okay, so the screener required at least a 10% edge, and after that, it said, "Well, show me in this particular expiration the one with the highest win rate," and this produced the 589, 585 put spread. So it analyzes the put spread. When we look at the price of the put spread, you have a bid and an offer, right? So market always has like this bid and an offer. And we could reference those prices, but when we plug it in and try to analyze it, which price do we use? So in this case, we're looking at the ask price, because if we're looking at a purchasing, bear put spread. You're buying one, selling the other. So because there's a displayed offer, we're going to analyze it from there as a starting point. But keep in mind, as a trader, you're always trying to get a better execution. So if you have a bid and offer, and we'll analyze this later, but if it's 10 cents wide, 20 cents wide, 30 cents wide, you're always trying to get a better execution for yourself. As a starting point, we're just looking at the displayed offer where you could get an immediate execution. So that offer is $1.90. Now, that's our starting point. How do we start to analyze this? And again, this is under the assumption that we're looking for a bearish put spread. If you're looking for a bearish put spread, you have to have that outlook, right? That SPY, you think there's a good chance that SPY is going to go lower, and if you're holding into expiration, that it will be below $585 at expiration. That's where this put spread is worth the most money. It'll be worth $4, the difference between the strikes. If we are fine with that outlook, then we'll take a look at it and say, okay, how's this put spread priced? And when we look at financial assets before we make any type of investment, it's standard practice to look at valuation prices. How do I price this asset? What are the benchmarks? Where do I think it should be? Is this on the higher end? This is on the lower end? Or if it's outside my price range, maybe the market is signaling something. That's also something to consider.
Hey, D.
Yeah.
Rob is asking, when you're looking at the trade cards, do you have any priority with edge, win rate, etc., or do you consider them equal, or do you tend to? He says, I tend toward the win rate more than the percent of edge. He's just asking about those numbers. How do you look?
I think that these two numbers are just telling you something different. One is telling you how far the price is from its average price, long-term average price. The win rate tells you, if you look at this price, how frequently historically would have it ended up in a profit, given the historical stock behavior, and given what the stock needs to do to make this profitable. So there is no priority. I get this a lot, but it's just telling you, it's two different metrics. If there was a metric, if there was one magical metric that you give a priority and just look at that, we would only show that, right? So that would be the only thing we would show, because everything else wouldn't matter. That means, here's one metric, all these don't even matter. It's just something fun to look at. So we would get rid of those. But these are just telling you two different things within your analysis. And it's a model, and models have assumptions, and models have data that you're inputting as well. So it's like, what data are you putting in? Are you putting 1 year's of data, 2 years of data? What are you doing with the outliers? Are you removing earnings data? Are you including earnings data? So all that you have to keep in mind. It's coming up with a general base model to start out with. Like, how is this price even within some range based on historical? Just like if you were going to go, let's say you're going to go and buy a house, right? Well, you could go and buy a house and just whatever the offer is, you just pay it, right? Somebody asks you, oh, okay, I want $300,000 for it. You're like, okay, I'll pay it. But if you're going to get a mortgage on it, the financial institutions won't allow you just to do that, right? They're not going to just say, go ahead and just, pay any price. They're going to make you, and you have to act like you're your own bank, right? You're your own financial institution. What are they going to do? They're going to ask you to get an appraisal, right? So an appraisal is a valuation model. What is this house actually worth? Is it, if we're going to give you a mortgage, we're not going to give you a mortgage for, 300,000 or 250,000, whatever it is, if we think it's worth 100,000, right? They won't do that. So they're going to go get an appraisal. You're not going to get a mortgage without it. They're going to go, and check for, other risks that are involved. They're going to go down their list. Is there a tax lien on here? Is there, they're going to, you're going to want to get an inspection on it. You're going to do all these things prior to getting in. Now, of course, in real estate, when you're buying a house, you have all these different professional people along the way helping you out, right? Like you'll have your real estate broker helping you out, your mortgage broker, title insurance, your inspector. You have all these people that you're paying these fees to. With the options market, what happened was they removed all that and said, it's up to you to handle that. And that's what we're doing here, is like saying, okay, if all this now is, quick access, cheap access to the markets, and there's no hand holding, they give you, here, open the account and go enter in your orders. It's up to you to do those types of, checks and analysis to protect yourself. That's what you're doing. You're trying to protect yourself, because the takeaway right now is, even by the SEC, is that, okay, this is your money, and you could risk your money any way you want. Right? It's up to you. There doesn't have to be a middleman, explaining to you, well, look at your risks, do your evaluations, do pre-trade risks. Nobody's out there, that is that middleman, helping you out. They leave it up to you. So that's what we're doing here, saying, okay, so how do we start evaluating this? If we're doing that and we want to go through our checks, right? What is my outlook? What is the strategy? What do I think I have it valued? What are my risks? What are my potential rewards? What do I have to think about ahead of time before I get in here? Does it fit my overall position? How do I manage it afterwards? This is all left up to you as a trader. And, many people just skip those parts because it's much easier just to enter in and shoot out orders. So this particular part is just looking at different benchmarks to try to help us evaluate the current market price of the strategy. And to do that, we run it through a model and compare it to historicals. Where does it lie versus the historical average price? How frequently historically would have this paid off given SPY's stock behavior? So that's what this is looking at. Okay. So looking at this, right? We look at $1.90, and the question would be, well, okay, if there's $1.90, based on how SPY moved around historically, given the same days left to expiration, given the same, current, the last spot price versus the strike prices, on average, what was the end value of this put spread? Like at once stock moved around, wherever it ended, at parity, what would be the average value? Well, that's 211. So looking at this,
Hey, D.
okay, yeah.
Rob did ask at some point, would D please click on the upper right corner to open up the analysis? Those are good, but many users may not know about them.
Yeah, no, thank you. Yes, if you wanted to learn more about this, there's a report here, and if you click on it, it goes through, and you could open it up and start reading about, you know, analyzing the strategy from different perspectives like this. So yeah, thank you. That's another way to kind of dig deeper in there and try to, you know, analyze it further. So I'm going to close this for a sec. Um, so how do we just look at these numbers and understand them? So from the perspective of looking at the market price and the average end value, we could see that, yes, there's a difference there. And the market price is currently below that average, historical average. By how much? Well, if we took it in percentage terms, it would have been like an 11% theoretical edge. So that's the average, right? Now the average could get pulled up because of an outlier or because it's data. And sometimes in the data, you have these anomalies or outliers. Like one day, I think somebody actually pointed one out yesterday in GME. We had a really big outlier. So we're going to take a look at that and maybe even cap it. How do you handle outliers? Because sometimes like maybe a stock is up, 800% one day, but do you expect that to happen? Even though it happened historically, if you look at the situation, probably will not happen. It's not likely to happen again. So one way then, another metric to look at, because that's the edge based on the difference between market price and average price is, well, how often, right? How often would this 190 have resulted in a profit? In other words, like if we went into our database and said we have all these observations. So from this date to this date, SPY did this, the stock. So in this scenario, the spread would have been worth $2. So that would have been a profitable. In this scenario, the options both would be worthless, it'd be zero in this scenario. So if we look through all our observations and said, how many times historically, based on what the stock did, or what percentage of our observations would this spread end up being more than 190? Okay. And that was 52% of the time. So that's how you use these two numbers, right? We get this big average potentially, but even if though we have a big average, it might not, tell you the whole story. And if you have a big win rate, it might not tell you the whole story, because there are times where you could be 90% win rate. But keep in mind, with options, the payoffs are different, right? So the 10% that are, losers could offset all those winners. And that's important, because you're like, well, why would you want to make a wager on something where 9 out of 10 times, you win $1, but the one time you lose $1 million? Like, why would you want to do that? Right? Just to say, well, I had a 90% win rate, but I lost, $1 million. You wouldn't want to do that either. So that's why you're using them together to paint yourself a picture, of the potential risks and rewards. That's why these two are telling us two different pieces of information. So in this scenario, we're looking at, there's some theoretical edge based on this model and this data, and it looks like, that 52% of the historical observations, this would have resulted in a profitable trade. Now, if we like that scenario and we want to investigate it further and say, okay, the stock is like 586, You know, if I think it's there's going to be some pressure on the market, I might want to just hedge some of my long deltas or just, you know, whatever you want to do that you have that outlook. This may fit. We could go and look at it further. So by clicking on this arrow options chain, this will take us to the options chain, set up this particular strategy for us. We'll hit, you know, run this analysis, and it'll give us more data to investigate further, right? So this is kind of like these quick reference points to see, well, you know, here's some ideas. You could go analyze this further, see, you know, what else we could find about it. So I'm going to click on this options chain. And now you can see it took me to another screen. This is SPY's options chain. Let me close this menu here. And below, it populated this spread for us just to make it easy. Buying the December 27th 589 put for 788. So you could see here where we got the prices. Let me see. Here's the 589 put. This is the 589 strike, and the put is over here. So you could see $7.88 is the offer, and then selling the 585 put for $5.98. So this is the 585 put, 585 strike. This is the bid. So if you're selling it on the bid, 598. So you see here, populated this strategy for us. And if we run an analysis, click this, it's going to produce us all these new statistics for us to look at. And once you get used to it, you're going to be able to scan with your eyes and quickly evaluate it. But let's just go over it here. So here it goes over the historical stock distribution again. So I think I have the dates set here a little bit different. And what it's saying is that the theoretical value is $2.14. That's a 24%, 24-cent edge, the difference between the market price, 190, and our theoretical price. And the historical win rate, 52%. So again, that's based on how the stock, we just looked at the historical stock distribution. How did the stock move? Based on that, that's the difference. Another model, just to show you that there's other ways to, you know, evaluate it, different models to use, is we could look at SPY's historical option chains. So let's forget about the stock for a second, and let's look at SPY's historical options chain. And based on historical options chain, we could figure out the implied volatility curve and skew, right? We could go and see historically, well, how did all these implied volatilities look like? And if we applied that skew, right? If we found a similar spread, right, historically, and applied the same skew, the skew moves around. But if we look, if we applied it, and keep in mind that when you're doing a spread, like a vertical spread, usually there's some kind of relationship between the two options. They can't get skewed way too far out of, you know, out of whack. But if we looked at the average and said, on average, how did the options implied volatilities price this spread? So that's the difference. One is looking at just how the stock did, ignoring what the options did. The other one is saying, well, given the state of the market we're in now, like with the same days to expiration and the distance of the strikes, same distance from spot price and from each other, what would the average spread be worth running the Black-Scholes model, right? So that is $1.91. So you can see that is in line with what the markets are priced now. So the markets are usually priced this way. That's what it's telling us. There's a penny difference. The median price, so that's the price right in the middle of, if we took all our observations and said, well, give me the price where half or above, half or below, that's $1.92. And what if we took the high-low range, right? The lowest the cheapest this we in our observations, and the highest this win. Given the state of the market, that's between 168 and 207. So, from a stock return distribution, looks like there's a little bit of room there. It's priced well. From the implied volatility point of view, looks like it's kind of right in line. So let's look at this further. And here we see that the market itself, the bid and offer, is $1.35, 190. So that's pretty wide, because right in the middle, the midpoint is $1.63. And if we're interested in it and looking at it, $1.63, if you could get that at midpoint, that seems like it would have been a really good deal, because that's on the low end, of the. Now this is wide maybe because yesterday at the end of the day things wide now, but of course there's a lot of room there. That's a pretty wide market. Take the percentage difference, between $1.63 and $1.90, right? That's a big difference. You got to think of it's the difference if you were buying a house for 190,000 or 163,000, that's a big percentage difference. So there's a lot of room for potential price improvement. You got to take that into account. A lot of people skip the execution part, but the execution part is really important. Like, where do you get executed on this trade? And think of it this way: if you're paying $1.63 instead of $1.90, well, you risk less money, right? You have less at risk. And if you're buying it for $1.63 instead of $1.90, well, there's more potential return, right? Like, let's say at the end of this expiration, if it's worth $2, well, if you bought it for $1.90 and sold it for $2, you made 10 cents. But if you bought it for $1.63 and sold it for $2, well, now you made 37 cents. So execution is very important, and people keep metrics and strategies just for execution. And this is one kind of scenario where it popped up that the markets happen to be very wide here. So this is a good example of that. All right, well, I'm going to stop right there.
Yep, the bell just rang in the background. Great job, D, as always. Thanks, everyone, for joining. Remember to like and follow us on YouTube, and we will see everyone on Monday. I did put out the exchange schedule in the chat so everyone can look at that. We're off Christmas Day and then New Year's Day, so coming forward. Great job, D, as always, my friend.
All right, thanks, everyone. Have a great weekend. Have a great trading day. Hope to see you guys Monday.